Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Rob Almeida, Global Investment Strategist at MFS, and James Ragan, Director of Wealth Management Research at D.A. Davidson. We're here to discuss why there is a paradigm shift taking place in the economy and the market. Gentlemen, it's great to see you as always. Welcome back to Trade Talks. And Rob, let's talk about that paradigm shift. Where are you seeing this taking place?
Sure. Well, I think if we take a step back, oftentimes in life, our immediate surroundings are so ubiquitous that it's hard to see the forest from the trees. So when you think about the last 15 years, the primary drivers of return on capital, which is what drives financial asset prices, has been falling interest rates, artificially suppressed interest rates, to be more specific, and globalization. So I don't think it's a coincidence that what you saw in the 2010s was stagflation, slowing economic growth, low money velocity, no inflation, but all-time high profitability. So that wasn't just a correlating factor, that was actually cause and effect. So as interest rates were falling, artificially suppressed, it was a function of consumers not purchasing goods, banks not lending capital, and companies not spending money. And at the same time, offshoring labor, production, et cetera, specifically to China and broader Asia. So the paradigm of elevated returns on capital and very low economic growth, low money velocity, low inflation, low rates, low unit labor costs, et cetera, that ended. That ended in 2022. So the new paradigm that we're in is one of unsuppressed interest rates, and we can discuss or debate if those should be higher or lower, but they're not suppressed like they were before. An era where maybe globalization hasn't ended, but it's certainly changing, where if you're a procurement officer, you don't have that same level of confidence that you can procure a good or a part to get to the end customer as fast as you could before. All of this has changed the dynamic where companies are being forced to pay more for OPEX, pay more for CapEx, and at the same time, capital is no longer cheap. And so I think investors are focused on the current headlines around inflation, potential monetary policy impact, et cetera. And I'm not dismissing their relevance, but the broader, more important point is, how's that going to impact the bottom line, corporate profits over the next several years? And I think there's going to be a very different outcome than what investors are expecting.
Right. And James, it really is a tale of two markets in 2024.
Yeah, Jill, if you look at just 2024, I mean, we really see the period from, say, January through April, where cyclical sectors were doing well. I think the S&P 500 was up close to 6%, but we had communication services doing well, but really sector gains were from financials, industrials, energy, and I think what was building there was a kind of a no landing potential outcome that investors were looking at, where economic growth was ended the year a little better than expected. There was a lot of optimism building the year. Now, fast forward to the last couple of months, May and June, and we've seen a shift. I mean, the gains have all been coming from technology and really semiconductors within the technology group. We've seen those cyclical sectors start to lag. And at the same time, the economic expectations, I think, have diminished a bit. I think investors are still looking at economic growth this year, but we're hearing about a soft landing again. Can we manage a low growth but a decent environment for earnings to still flourish? And I think that's leading to some questions about consumer spending. So some of those cyclical sectors that led in the first 4 months have really lagged here. It's maybe changing in the last few days now. But overall, May and June have been very much led at that, the technology semiconductor rally.
Right. And let's talk about that more, Rob, because in addition to the tale of two markets, it also feels like there's a lot of bifurcation in the economy as well. And I want to debate this for a moment here. Your initial comment, the way we have been used to a certain kind of environment over the past 15 years, which you argue the environment that we're in now, which, by the way, interest rates are at relatively historical norms. Perhaps this is reverting back to what normal might have been, because really, it was an anomaly, the type of interest rate environment that we've become accustomed to.
Yeah, and I think anomaly is an understatement. It was a 5,000-year low. So the Bank of England's done some phenomenal work on this, and go back to a paper they wrote, I don't know, 4, 5, 6 years ago, where they triangulated capital costs going back centuries. And what you see in the piece is largely interest rates are at a 5,000-year low. So in our lifetimes, everyone watching your program, in their lifetimes, interest rates have done two things. Went from a 5,000-year high in the early 80s to a 5,000-year low in 2021. Now, why is this relevant? It's relevant because the purpose of capitalism is to take capital from underperforming investment ideas to potentially better performing investment ideas. And interest rates help with that. Right? It's the barometer for the broader economy. But when you suppress that, you suppress the purpose of interest rates and capital investment, and malinvestment accrues. So I think you have euphoria building in one area of the market, which James referred to, surrounding AI. But even away from that, what you had was years and years of potentially weak investment ideas that were funded because of an anomalous interest rate environment. And I think we've yet to see the consequences of that.
Yeah, I mean, and James, we're seeing this in the private market as well. It's no longer growth at all costs, but where balance sheets and being able to manage through volatile environments and governance really does matter when you think about it, as we're starting to come into earnings season here, where you have to be able to justify these multiples. And it goes back to what you were saying before about a tale of two markets, where some companies have been able to make this pivot and understand that we're back to, I guess, perhaps a historically normal environment, and some that just haven't, because they have no benchmark in terms of how to manage in these kinds of environments.
Yeah, I think that's right. I mean, if you look at just the overall earnings estimates for, say, the S&P 500 as a whole, despite the first quarter coming in, relatively better than expected, we have not seen the earnings estimates for the full year drive higher. Maybe 2025, we've seen estimates move a little bit higher. But so, as we look at the next few quarters, I think in the second quarter, a lot of those AI generated earnings will still be good on a year over year basis, but they'll come up against, tougher comparisons in the latter half of the year. So I think investors that are looking for, an increase in earnings growth could be disappointed. But, I think there is earnings growth below the surface a bit. You can look to other sectors kind of away from the AI. And, we did an analysis of the S&P 500 and found, we found companies in all 11 sectors that have earnings growth faster than what we're seeing from most of the AI companies, and that are trading at, in many cases, more of a discounted valuation. So there is opportunity for investors looking for growth, but we do think it's going to be a challenge to get it out for the market as a whole.
Right. Well, I mean, of course, you have to ask yourself, what kind of investor are you, right? I realize if you're a portfolio manager and you're measured against your bench, and if you don't have some exposure to these companies that are in the race for trillion-dollar market caps, it's going to be tough to make your year. However, if you're an investor where slow and steady is more of how you want to construct your portfolio, it doesn't necessarily mean it's better or worse. It's, everyone's outlook is just different.
Yeah, I mean, I think that's so important. I mean, I work for wealth management, and we're working with individual investors that are constructing long-term portfolios. So, we want to develop strategies that are going to, work over time. And that involves, rebalancing portfolios and making decisions that'll reduce risk, but still, keep up with the market over time. And so that, that's kind of where we're coming from on that.
Yeah. And Rob, when you think about portfolio strategy or positioning for the second half of the year, what's your thoughts there?
Defensive.
Mm-hmm.
So I manage a multi-sector income portfolio where I've got to make intra-sector decisions, intra-asset class decision, but broadly fixed income versus equity. So I'm overweight fixed income, underweight equity. But to echo James's comment and your comments as well, I maybe think about it like this. So the paradigm shift that's happening, the paradigm that we were in was an environment where it was survival of the least fit. And that's not the purpose of capitalism. And I think now we're in a world of normalizing transport costs, normalizing labor costs, normalizing capital costs, where you begin to see the creative and natural selection process of markets start to work its way through. We transfer from survival of the least fit to survival of the fittest. So I think when you look across the sectors, you're going to find companies with a product or service that people want, that can charge more and absorb those, I don't want to call them new, but elevating input costs. Those companies will survive, and they're going to thrive on the other side of that when the natural selection process goes through, because they're going to have less competition. So I think what it comes back to is an environment where everything was up and to the right before because of the interest rate environment, because of the globalization environment. Now you have some things up and to the right and some things down and to the right. And that's where security selection, I think, becomes really paramount.
Yeah, and I think it's a good point that you make, because it's one thing to tell the story that I have either blockchain in my name or I have exposure to AI, or we have a product that's being developed. I feel like, particularly in the tech sector, you should be working on problems that need to be solved, right? For your your go-to market to be in demand. Just simply saying that you have something attached to your name or you have a story to tell, if you're not solving any problem, there's just no longevity there. I think that's the existential issue I'm trying to work through.
Yeah, and I think this is something you find, at least I find in my personal life and professional life, people tend to confuse science and investing. And those are two different things, right? So let's not confuse the commercial application of a science with the science itself. So you have science and it might be society impacting, but is it differentiated, right? So who has an economic moat levered to that science? So when you think about 3D printing technology 20 years ago, why wasn't it commercially successful? Because it was democratized. One wasn't very different from another. I think a blockchain not dissimilarly from that. So ultimately what matters is the commercial application of the science. So now you have this euphoria surrounding AI, and what's really going to matter is who has the AI that someone's going to be willing to pay for.
Right. And it also goes back to your point, James, in terms of looking at different sectors as well. I mean, it's almost like you could produce all the EV vehicles you want. If you don't have the infrastructure or the power available to make these things run, there's just so much more that goes into it than simply having the technology available. And I think perhaps the market got ahead of itself as it relates to the stories versus being able to practically apply this. And I think with earnings in the back half of 2024 and 2025, you might have to come to reckoning with some of these.
Right. Well, I mean, if you just on the first comment there, just on related to AI. So, I mean, we look at AI, so far it's been, as I mentioned a couple of times, the semiconductor stocks have really done well as the investors are kind of training their systems. Ultimately, the companies that are adopting these chips are going to have to develop revenue models that are profitable, and so that's companies that can maybe save some costs along the way, or maybe generate a new product which they can charge customers for. So I think the jury's still out. There's a few companies obviously that are doing that already, but mostly it's just companies that are that are making the the semiconductors right now. Obviously there's a whole opportunity maybe in generating power over the long term, but that's something that's gonna will take years for that to fully come to fruition. As far as other companies, I agree with Rob that we want to have some defensive exposure in the market over the second half of the year. But I would also say, as I was saying earlier on how the cyclical sectors were doing better earlier in the year and the last couple of months have stalled out. If we do go into a slowing economy, but we stay positive, say GDP comes in at 1 to 2%, somewhere in there, we would expect then the cyclical sectors to do better, because that's positive growth. So we're watching the consumer data right now, which is starting to roll over a little bit, and I think in the short term it's a little tricky because the market kind of expects the consumer to slow down. And so if we're seeing slowing data, it's not necessarily a bad thing. It could be bad news is good news for the market. But if the consumer slows down even more than expected, that could be a negative. So we're playing a fine line here. Things could slow down more dramatically, and so I think it is a reason for staying diversified. And given the growth that we've seen in the tech sector over just the last couple of months, it's one of the best opportunities I've seen in a long time for investors to rebalance the portfolio, so they can keep keep their exposures in the market, but start to trim aggressively those stocks that have really done very well and reallocate into the quality stocks that have underperformed. And that's might not feel good in the short run if the momentum continues to run, but I think it's absolutely the prudent strategy for a long-term investor.
Yeah, and Rob, to wrap up here, I mean, perhaps we have to let the economic cycle happen this time versus propping it up and letting things fall out, and see where they fall into place so we can get back to some sort of normalcy here. Do you think about the business cycle?
Yeah, I'm not an economist, but
right.
I'll pretend to be one for a second and just say that, I think investors today are majoring in the minor when they should be minoring in the major. So there's so much focus surrounding the pace of inflation and the the economy, soft landing versus hard landing, et cetera. If you think, what is a recession, right? The word recession, recede. Something needs to recede because it was in excess. So in the 90s, it was IT hardware. In the 2000s, it was unproductive real estate. In the 2010s, what was it? It wasn't a tangible good that you can see. We didn't build anything. All that happened was central bankers unintentionally transferred wealth from savers to levered income streams, i.e. borrowers. Now that wealth transfer is happening back. So back to my comments about the economy, what needs to recede is what was in excess. What was in excess was a historic epic level of balance sheet financialization and offshoring that drove all-time high profitability. And that's what needs to recede. So my concern is that we can have a profit recession or a poor profit outcome, but still have a positive economic one.
All right, gentlemen, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.
Thank you.